Welcome to ATRAM Game Changers, the podcast that invites you to explore the exceptional minds of our time. Brought to you by ATRAM, the leading independent, digitally powered asset and wealth management firm in the Philippines.
Welcome, everybody. Welcome back to ATRAM Game Changers podcast. My name is Phillip Hagedorn, and today I'm here with my co-host, Sandra Araullo, our CIO, Chief Investment Officer at ATRAM. And want to welcome everybody back. It's obviously been a very chaotic couple of weeks in the markets, and so we felt rather than invite a guest and torture that guest today, we'll have a chat with Sandra.
Talk about the elephant in the room, right?
Talk about the elephant in the room. So today what we want to do is kind of touch on three subjects. First, number one, what is going on out there in markets and why? Two is how that might impact the Philippines, maybe. And the third question is, what do we do about it from an investment point of view? No, so we'll try and tackle those 3 points in this morning session. So, Sandra, what is going on out there?
Well, I'm sure everybody's quite aware about all of the tariff pronouncements that have come out of the White House.
Yeah.
I mean, specifically, blanket tariffs, tit for tat, retaliation from China, markets reacting to every little tweet or speculative noise around updates. No?
So why are people so afraid of that? Tariffs? Maybe we just go down to the crux. Why are people so afraid of these things?
Tariffs are taxes, right? Basically, so it makes it more expensive for it disrupts global trade. It's like throwing a wrench into a machine that has been run like a car's engine, global engine, no trade, and throwing a wrench into it, and parang nobody knows. Well, we can anticipate what it might mean, but basically, it is very disruptive to the global trade.
So why do you think President Trump? Why do you think he's doing this? What? Let's just get down to the.
There are a lot of schools of thought around it. I think it's less. We can debate or we can analyze. I've been analyzing this for 2 weeks about what the motivations might be. But the bottom line, I think, is what is it doing? No, so what we know is there is something that's motivating Trump, whether it's the fiscal deficit, whether it's asserting itself as the global economic leader, etc., geopolitics, whatever it is. The pronouncements are coming out from left field in the sense that even when he was actually saying that, Trump, even in the 90s, right, he's always been a tariff guy, no? Yeah. And his background, and parang in hindsight, it's so clear, no? But at D-Day, on Liberation Day, the market was in denial about
I agree.
Trump
I think,
kind of really following through. But then again, a day later, you have all of this analysis around the art of the deal, negotiating tactic, blah, blah, blah. Some of it is playing out. But I think, again, all of this noise, all of this, back and forth, what does it mean for us? What does it mean for our portfolios? What does it mean for our strategies? Yeah. I think that's really the crux.
Well, I agree. I think obviously the impact is personal, right, for everybody. And but I was thinking about this as well, and I guess Trump runs on "Make America Great Again" theme, right? Implying that America is not great right now, which to me is already the wrong premise to begin with, right? America, I was looking at it, and it's all data-led, right? In 1990, when the Cold War ended, America's economy was about 26% of the global economy, of the world economy. Today it's 25%, $110 trillion global economy, and the U.S. is in the 28, 29 trillion range. So they have not lost any power since the Cold War in terms of, economic strength. We know that from a trade point of view, they are a consumer of everybody's products, right? So they import a lot of consumer products, goods from China, particularly cheap goods, but they also export, right? They export super expensive services like accounting firms, lawyers, banks. I mean, services that are global in nature, where they have a trade surplus in the services side, right? So the premise that America is not great is kind of wrong. So I'm thinking, what is this? Does he want to bring manufacturing back to the U.S.? Again, I cannot imagine, and we've all seen the memes, I'm sure, of, retired Americans working behind sewing machines. That's not going to happen, right? That's not going to happen. So it's Trump being Trump wanting people to negotiate with him. It's going to take 90 days now. Now we know, at least. I guess that's the best part of this week, is that we know the time frames of when deals might be negotiated, and we'll be able to figure it out. Do you agree, though, that maybe a consequence of all of this at the moment is that global growth will slow down a little
100%. 100%. I mean, even if he walks back on the tariffs after 90 days, companies would have already pivoted and planned ahead.
Or slow down,
and suspended or backtracked. No, we've seen it. We've seen it in our own listed companies are not even yet this wave of tariff announcements, but the previous previous round. I mean, it's been going on since 2018, right?
So I have a question for you, Sans. Global growth slows. I'm not suggesting a recession, right? I'm just suggesting slower growth.
Mm-hmm.
Is that good for the Philippines? Or not good for the Philippines?
There are two scenarios. One is where in the US, so it's either recession or stagflation. Recession is where your growth slows. Technical recession, 2 quarters of slow growth, right? Slower growth, low inflation. That's a recession, technically. That's actually a good thing. The bad thing is when you have low growth and high inflation, stagflation. That's a bad thing. That's where it's bad for everyone.
So that's where this whole high tariffs and killing growth
is threatening, really threatening the expectations of investors. And it's reflecting not just in the equity markets, but also in the bond markets. Actually, that's why Trump backpedaled. Overnight, the bond markets, which initially rallied, so safe haven, U.S. Treasuries, risk off. So it initially rallied upon the announcement of tariffs. And then, when the tit for tat started to happen, China started to retaliate and it was escalating. All of a sudden, the bond market started to kind of catch the cold. And it's a much, much bigger problem if the bond market starts to really sell off, in the sense that it snowballs. The US needs to refinance a lot of its borrowing. They have to do it at higher rates, and it's gonna go into this huge debt cycle, not unlike what we saw in the last when did it happen? 10, 15 years ago? The sovereign debt crisis in Europe, no? So that one is no go. And then a lot of noise around, Trump's not gonna allow for... I mean, it's not so much noise. It's actually, I think there's a valid argument around Trump associating his own success towards the stock market's performance. And he will not tolerate being associated with a bear market in stocks, no? I mean, it was, he
did for about 3 days. And then
he did. Because the bond markets started to react. Then it becomes... And, I mean, it's actually an interesting dynamic. It's on the surface, it's very easy to write off Trump as this madman. He's just, but I think we are underappreciating the complexity of the situation where you have, real, technocrats, the likes of Ray Dalio, for example. There is a big underlying current around a changing world order. And the Make America Great Again, I think it's just a marketing thing. But at the end of it, there is a changing world order around the US kind of coming down and China taking the lead.
When you look at the economies, I was, again, looking at data, 110 trillion global economy. The US is 28 trillion. 17 trillion is China, the next largest. And after that is the Germanys, Japans of this world. Guess what they are at? They're only at 4. They're like 1/4 of what China is in terms of the economy. So you cannot just brush aside China and bully them. I mean, they're a huge economy as well. And so, I think this 90 days is going to be quite interesting. I would expect that, I think from, the very beginning of all of this, everybody expected there was going to be a negotiation. It would turn out to be a win-win, but favoring a bit the U.S. because that's what Trump needs.
Yeah, actually,
right?
the Art of the Deal, the book that Trump wrote, is like the playbook. He is doing exactly what he outlined in that book. And it's interesting to see it play out in the geopolitical
Not everything
sense.
that he did in that book worked out quite well.
Exactly.
Though, right? So
but
I guess
the framework is there, right?
No, I think that's that you're absolutely right. That there is a playbook. We now have data. We now have his hand, because he kept his hand close to his chest, and in those big cardboard cartolina posters, he showed his hand. And I think from here it'll be that. So back to kind of, okay, so markets are going to be a bit turmoilish. I think if you take a bit of this noise out, you could also make a pretty clear argument that the U.S. market needed a bit of a pullback.
100%.
Needed
100%.
a correction, needed an excuse to take some cream off the top. Is
100%.
Is that something fair to say as well? I mean,
100%. I mean, it's the big debt cycle, diba? If you keep on spending, I mean, the fiscal deficit is real too. Keep on spending, there will come a time when you need to pay. And that's the part where you're either gonna delay it or you're going to bite the bullet. And that means a little bit of, tempering on growth. You can't be growing. Productivity growth is pretty smooth over the long term, but there are a lot of gyrations around that slope, no? The problem is, the liquidity in the market, money, credit, it did not necessarily go into productive capacity in the US. In China, it did. It was buying a lot of, that's a different animal.
Infrastructure, one side versus the other. Just looking
you're
at
buying
infrastructure.
televisions, you're buying gaming consoles on credit. How is that adding to productivity? Probably not even, right? So then...
Well, it's adding to productivity of China because they're all coming from China.
Exactly. So there is that, big picture reality. And everything that's happening is kind of geared towards maybe prolonging the dominance or somehow... Because China has its own problems right now, sure, no? But I think as a leader on the political side, Trump does have something to prove, I guess. So he's being himself, being unpredictable. What does this all mean for us as investors? What does it mean?
Yeah, I guess let's start first for the Philippines. I guess, what does it mean for the country, and is there an opportunity? Some think there might be for us. That's one. I think just to finish the market stock, I think we have equity markets. Europe was leading the way this year. They were up 13-14% at one point. All of that has been taken away. it's flat. So
Europe kasi is the biggest, they have the biggest dependence on the US as a market. China doesn't even, only 4%.
Yeah. Well, it's interesting what's happening in Europe because they've been looking for a catalyst for growth in their economies, and now they want to do this huge defense spending budget that could be a catalyst for growth. So I think European markets were nicely in the positive until this week or last week. Well, it's this week. We had a holiday pala in the middle of the week, right? And so we've seen them sell off. We also saw Hong Kong, which was up in the mid-teens, has also pulled back to kind of a flattish return. The U.S. markets, which have had 2-3 fantastic years, are down. They're down. I think the Nasdaq is in the 20% range, and
flirting with the bear market
S&P
line.
At 15, the Dow at 10, and obviously those are big moves for that big market. But for the volatility nowadays, to me, that's not anything to really, I don't think it's panic time, right? Put it that way. So, maybe valuation will tell the tale at the end of the day, and things are adjusting to that. But for the Philippines, I have two takes here. One is, a slower growth in the globe means lower energy prices.
Yeah.
And lower energy prices is super important for us because that brings inflation in check, keeps inflation in check. And I don't know if you've seen the latest rice prices as well, they're at, 3 or 4 year lows as well. So the two key import factors for us that we import a hell of a lot of are going to be quite stable in price. And that's pretty good for the Philippines. So from an inflation standpoint, we should see inflation stay quite low.
Actually, that's why earlier I said, my two scenarios, recession in the US or stagflation, recession being the higher, base case, is actually good for the Philippines. Because you've had US exceptionalism for the last 2-3 years.
Yep.
And driven by a lot of what's happening on the tech side. Very high beta, so they're also suffering from the volatility. But if you look at the big picture, they're up threefold over the last 3 years, right? So, it's just a blip, and it doesn't take away from the actual productivity that it had managed to produce, right? Technology growth. But
are we seeing any signs of that rotation already, where money is finding other places at the moment?
There is repricing for sure, because in the last 2 years, especially in the beginning of 2024, when the AI hype, really lifted the markets. I mean, it's only the Magnificent Seven really moving. Everything else is quite flat. The growth, the hyper growth assumptions that the market was using to discount the future value of these tech companies were pretty awesome.
Yeah.
So that one, medyo parang okay, a little bit of sobriety. Maybe it's not 60%. Maybe even just 20%. But that move, that delta, is still significant, and it will reprice the market. And it will take away a lot of the froth, as you said, from the US exceptionalism narrative, and it gives other economies, especially super undervalued EM, like the Philippines, especially also put into the mix the whole currency play. Part of why we've languished in this market is because the peso against the dollar. If you're a foreign investor, why would I put money in the Philippines? I'm gonna, the currency is gonna wipe out any gains I might earn from EPS growth. So now you're seeing, broadly speaking, the US, their bond market's selling off, the dollar is kind of selling off. And then we have our
Which
own...
Which means less pressure on currencies.
100%.
And not just the peso, but
so, once the dust settles and it's a recession, like the likelihood of a recession this year for the US becomes the base case, you will have investors looking outside of the US. And like our market, really, it's just, you've been around, Phil, for how many years? You know how much
I think
it can move.
Yeah, and it can move quickly, right? So I think from a Philippine point of view, we have an economy growing still at the 5% range. I think we've downgraded a little bit because we were a bit concerned, right, about these taxes and tariffs and what the residual impact, not the direct impact, would be on us. But certainly we manufacture products and export to China for export to the U.S. And that's slowed down a lot. So we have to, adjust. And I think it's going to take time, right? So we think, we were hopeful that GDP growth would get to 7% next year. I think there's an outside chance of that if certain things go our way, but we're more likely to be in the 6.2, 6.3% range.
What's your, Phil, what's your base, bull, and bear scenario? Because I just kind of like to think that way because it's too, if I try to think about too many things at the same time, it gets confusing.
Well, you know me, right? So I'm generally an optimist. So I think that people always find a way, the good way out, right? I mean, even COVID, we were worried, but we found our way out, right? And so, first, I think for the Philippines, right now, we are very friendly with the United States. The United States is still the largest economy in the world and will continue to be that way for a while. They will still consume the hell out of products, and they will still try to buy it from cheap countries. And whether we can take advantage of that or not, because we're not in the crosshairs of their tariff program. As a matter of fact, we are holding joint military exercises with them at the moment. Can we take advantage of that? Right?
Actually, the companies that we've been doing channel checks with have said that they perceive the relatively lower tariff to be a competitive advantage against those that, Vietnam.
I mean, we still have a lot of things to fix, though, because if we want to introduce more manufacturing, we got to fix our power costs. We got to make sure there's enough. Well, the nice thing is we have built a lot of power supply. We have, from an infrastructure point of view, I think Philippines is much better prepared than, let's say, post-Asian financial crisis, right? 20 years ago. We're way better prepared to move. But will we take advantage of this? Right? So I think from the upside opportunities, first, we're still a consumption-led country.
100%.
And the good news is that, people have jobs here. The unemployment rate is still very low. We have many, many young people getting into the workforce every year, generating GDP. And that's pushing consumption along at a 5% growth rate. What worries me is the recession in the U.S. If it's prolonged, does it impact the remittance numbers, right? Because that's still an important factor for us. It's still an important factor for consumption and all of that. So if that's if it's a blip, if it's a technical recession, which is the more likely scenario, then that's fine. Life goes on and we're good. But if the Trump tariffs spiral out of control, it could be bad, right? And so we have to wait and see. I think in 90 days we'll have a lot more clarity on what that will look like. But again, going back to the more positive outlook is I believe it'll be a negotiated settlement where people will be able to live on. Price adjustments will happen. There'll be inflation in some parts, and we'll move on. And then the focus will go back on interest rates. Do they need to come down? And are the economies back in a growth mode? And that's the basics. And people will look for valuation, and they'll spot the Philippines as a low valuation, and hopefully with high growth, because we're coming off the first quarter. We'll see the numbers in a couple of weeks. Should be pretty decent, at least from the momentum. So the upside is there. That's the upside. What's the downside is that, we don't have a lot of clarity after 90 days, that there's still, or it's enhanced. It becomes a real trade war with China, and it causes a lot more concern rather than clarity, right? And that will just keep foreign investors away. It'll keep people in safe instruments. It'll keep people in the dollar. It'll keep people in money market. money won't want to flow until there's more clarity. And that, that means we'll probably just linger.
Yeah.
Because foreign investors aren't here anyway.
Mm-hmm.
So we'll just stay flat and rely obviously on remittances. We'll rely on our consumption and achieve our growth rates of 5%. But, will it help us build more infrastructure and all of that? Maybe not as quickly.
So it sounds like, it's a very, how do you say, one end is quite away from the other end.
Well,
one end of the scenario is,
I think, in my view, when I'm looking at it, I'm looking at valuation companies in the market, right? From a market point of view, the downside is where we are. I don't think because the valuations are already 10 times, the companies are earning. Yun na yun, we're here. We were the first country to sell off and never recover from the Trump tariff announcements in October of last year. We were 7,600, right? And we're back to where we are with earnings supporting these prices. So if the noise becomes noisier, we're here now. I don't think we're going to sell off more.
The downside to upside
the
ratio
upside,
is...
the risk reward,
yeah.
downside to upside is clearly on the upside. And I think that's where we'll end up because back to your original point, Trump is very conscious about markets and the US is doing fine right now. He's shooting himself in the foot a lot of times with this stuff, right? Yes, the markets needed to correct. Yes, this is a great reason to correct. But believe me, if there was a real concern that this would be a massive blow to the US economy, the market would not be down 10%. It would be down way more than that. Way more, right? We were down 10% last month, for crying out loud. You know what I mean? Mm-hmm. It's not enough to say that the market is not saying the market is just saying, oof, relief, give me some cash. I can have a reason to sell some of this expensive stocks. But, there's 493 other companies in the S&P 500 that now might get some of that cream that came off the top of the Magnificent Seven, right? And keep the index fairly stable. I'm not suggesting it's going to fly, but consolidate as the U.S. needs to consolidate rather than massive correction. I guess that's what I'm thinking. So, with that in mind, you've got Philippines, looks like a peso that could be fairly stable because the dollar is not so strong right now. You have interest rates. Yesterday we had a cut from the BSP. They're already signaling more. Looks like interest rates are going to come down. Inflation is at below the 2 to 4% range. And the stock market is at 6,000, right? With earnings growth expected in the mid-teens or low teens. So what do we do? We have products out there, our funds, from the global funds, our two key funds. For example, our tech fund, right? The tech fund, which really has been a star for the last few years. Many people invested in it. It's done tremendously well. Obviously pulling back now. The fund is down. But I think I want to point out, if you're invested in tech, the NASDAQ is down 20%, more or less. That's the index. The tech fund, last I saw, was down around 8%. So it pays to have active management. No one wants to be down, but if you've been in this fund a while, the 8% is a bit of a pullback from where the highs were. And you'll see that the active manager, the management, the guy that's managing the fund here,
yes,
is really picking and choosing companies that he feels will benefit from the current situation.
Or
right?
maybe even raising some cash, just to sidestep some of the...
They may have raised a little bit of cash. Normally, I think maybe maximum would be maybe 10% from what I've seen. We've done that for some of our funds, that's for sure. But I think it's an argument to say why active management works versus just buying these indices, right? Because the indices, really, you're buying size.
Yeah.
In active management, you're hopefully picking a manager that can really select the right company. So for the tech fund, again, it's about the future, right? If you have never bought it, is this a good time to buy it?
100%.
It might be. If you're in it, is this a time to panic and sell? Absolutely not. I think it's a time to keep on holding it. But if you are interested in making investments, if you do have extra cash at the moment, what do? Do you take risks, or do you play safe because interest rates are quite high and you can get a nice return?
Yeah.
Just putting it in money market, right? So what do you think, Sans? I mean,
so many different lenses to look at this by, right? But I think for our actively managed strategies, we have been constructive on Philippines for a while now. You know this, Phil.
Yeah.
Beginning of the year, we're saying there's a lot of we prefer Philippine equities to global equities. It's playing out. But is it time to deploy, or is it time to buy the dips? I think I'm still watching what's going to happen in the bond space. Rates are high, but they can go higher.
Right.
And patience. I mean, again, this is where active management comes in, because timing the market is really hard for professionals. So how much more would it be for, the ordinary investor? You don't have access to all of you don't have a front row seat. And by the time you react, you're going to be whipsawed. Whipsaw means you're buying at the high the next day. Like yesterday, all of a sudden tariffs were suspended. So, or implementation 90-day delay. Markets celebrated like 16% up. Today, it's down again. Like, you don't wanna sidestep that and save yourself from the emotional turmoil, I think. And we live, breathe this every day.
Yeah.
What have we done? Certainly, we didn't react. We kind of looked a little bit further out, trimming.
Mm-hmm.
Turning a little bit more defensive in our positioning still. We don't want to take big bets because the uncertainty is quite high. I mean you can go down to the weeds, right? And even how the US will implement these tariffs are a big question mark. The legality of it. I mean, the 90 days is just top level announcement, but to actually implement it, how?
Right.
Who knows? So we're like, okay, we've made some relative outperformance as the market was going down, then I want to close my risk, diba? So that when it does go up, I'm still ahead. But that's very technical from an active manager's perspective. I think if for the ordinary
Let me
investor,
just ask you then the straight, simple question of if you had a bit of money to invest right now, would you be looking at, we say diversification is number one, right? You don't have to go all in into one thing, right? Would you be looking at a multi-asset strategy, right? Where you get placed, you're in there, when you put the money in there, you know that you have equities, you have fixed income. In our case, you might have Philippines and global all in one. And it's like your first step is just get that diversification, right? That's one. The other way is saying, all right, let's just put it in the money market first. Let's be patient. Let's wait till some smoke clears. And then we can easily switch from money market to a more aggressive strategy longer term. What would you...
If I had money to deploy now.
Yeah, what would you...
And I'm already invested. I'm actually invested in risk assets because I'm investing for my retirement.
Right.
I'd put it in bonds right now. Money market bonds.
So which fund? Which fund do you think would be...
And appetite, no? So let's say I'm really, really hurting from the
let's say
drawdown.
pesos first. You don't have dollars. So you have pesos. What are your choices there?
Definitely the money market fund. I actually have money in the
So money market fund has given about, if I'm not mistaken, first quarter return is about 75 basis points. I know. It increased a little bit at the end because it rallied. I think about 1%. Yeah. So it's tracking around 4% for the year if it continue to do that.
And it has access to BSP bills.
Correct.
Which is a much higher yielding instrument versus time deposit. No, so your money in the bank, you're better off moving that to money market fund without taking huge investment risk.
Would you consider, so we have a multi-awarded elite fixed income team, right?
Yeah.
That manages their total return strategy. And that one's up even maybe 1.4% in the first quarter. Would that be a good option versus money market? Would you say you're not putting on too much risk there by adding that or buying that one?
Again, personally in my profile, I would put it because I don't need this money. I'll put it
At
in
the
the
moment, yeah.
total return bond.
Over money market. If you had
Over
to
money
choose.
market.
So that's it's a little bit more aggressive, right? It's has more duration on it.
Yes, so
it's more actively traded.
Yields can still move higher.
So there's the medium term and the long term.
There's
right? You put it in medium term?
Today, yes. I'll put it in medium term. But I also know that the team is quite waiting before they go out the curve, the duration curve. So it boils down to appetite, risk appetite.
Actually, I mean, right now, even for decent returns, because if the scenario that I talked about plays out, where things settle, valuation comes back into play, inflation becomes the starting point, and people see that rates need to be cut, then you're going to have some decent total return for the rest of the year. And so, that 4 or 5% we're tracking today could be enhanced by 1% or something like that, right?
So I think, again, let's kind of simplify, distill. What is the objective? Is it stability? Is it income? Is it growth?
Well, me, I'm an investor. I want to make money, right? So the first thing is, I don't want to lose money, right? I don't want to see negative returns. So if you buy equities now, in 1 week, you might see negative returns first. I'm not suggesting it's going to be negative all along. No, it might be positive in 12 months. But if you buy equities today, especially global equities, I'm less confident of, you will scenario for a while. And you will have to stomach those losses while you're waiting.
Yeah, that said, if you're a growth investor, you need to have time in the market. And there are segments of the market, of the equity market, that is looking attractive from a growth standpoint. You have infrastructure fund.
So we have two funds, I think, that we want to kind of highlight here for that option, right? So if you don't want to be stomaching ups and downs so much, these funds have been a bit more resilient. They're less exposed to
defensive, so they're in utilities.
Sector and more defensive. They're the ATRAM Global Infrastructure Fund.
Yeah.
And the ATRAM Global Dividend Fund.
Yes, because dividends are also when you get something income
exactly.
or fee.
And the exposure is different. It's not in the tech space so much, which is high. It's not in automotive so much. Not so much in manufacturing. More services. So the dividend fund, for example, I think the largest sectors in the insurance sector and the banks. No, so these are two ways to add risk and maybe to
fulfill the growth objective
or fulfill your growth objective in a calculated, more maybe less volatile way. From the Philippine front, From the Philippine front, we kind of have the same thing, no? We have an index that's at 6,000. We originally had a view it should be back close to the 7,500 level. The team has kind of rethought this, and I think we need to get to 6,800 before we get to 7,000. So let's put 6,800 as the first target that we need to get to, which we should be able to get to, no problem, this year. And how do you play that? So the index is one way. Obviously, you can have 800-point upside from 6,000, 12% or so upside there.
But I think, Phil, the Philippines is really a stock picker's market.
100%.
Today.
I completely agree with that, Sans. I think last year, for example, we have our own Magnificent Seven.
Yeah.
Even if the market was down last year, 7 stocks that completely outperformed and these are not small companies. I'm talking about BPI, ICTSI, Century Pacific, Metro Bank, large companies that did very well, right? So, 2 strategies that I think have proven to do quite well in these volatile times is our Alpha Opportunity Fund. Why? Well, maybe one theory is that it's not in many companies that are exposed by the foreign a lot. So
Not a lot of large caps.
We're not feeling the outflows from the foreigners there so much.
Mm-hmm.
And it's, I think that's probably one of the main reasons. These are all non-index.
So it's a good way for us to express views that are fundamentally anchored and shielded away from a lot of the sentiment and flows that the foreign flows tend to dominate the markets today.
The second fund that's actually done quite well on the local end is the Sustainable Development and Growth Fund, which again is anchored on more sustainable development process in picking the companies. But clearly, these companies that behave well have performed very well. The performance, the fund has outperformed the benchmark, the PSEI, since its inception, actually. And the highlights of the fund kind of show that we're very heavy on the banks, which is, I think, a sector lots of folks are looking at right now. It doesn't have it has some property stocks in there, but it's not very heavy property. And quite well diversified with index and non-index as well. So has that characteristic of a little bit of the characteristic of the alpha opportunity fund.
It's a good mix of top-down macro expression and bottom-up company. I mean, the construction of that strategy is completely different from how you would typically manage an active portfolio. We're not anchored on the benchmark. We're having, we're scoring them according to a different lens.
Yeah.
It's more, again, sustainability long-term with a thesis that if you behave well, you will be creating value and it's going to come back in the price.
We launched the fund in February of 2021 and has delivered positive returns versus a market that's delivered negative returns. And when we track some key metrics like emissions, water use, energy use, as a whole, the fund clearly behaves better than, let's say, that the index does as a whole.
Mm-hmm.
So, again, a couple of ideas
for growth-oriented investors.
If you're looking at taking a bit of adventurous risk nowadays, there are opportunities there that could be looked at. And those that just want more security, the bond market still looks good.
Income now. So the difference, Phil, between today and let's say, 10 years ago, 5 years ago, is there is actual income to be made.
Correct.
In fixed income. There was a time when there was
Zero.
No income to be made, no? So that really forced investors towards riskier assets. But today, you can earn 6% on a 10-year government security. Then it's
maybe
quite
that
decent.
leads me to the last point here on income, because we are running the country's largest global multi-asset income strategy. That fund today is over 20 billion pesos in size. And, it's consistently delivered income since its launch in 2018.
About 6%.
Around 6% on an annual basis. But the NAV has been a bit active, right?
Yes,
there's years
because
where
it's a fund and it's
a regular
smart to
fund.
market.
Today, it's down around 3% from the last I heard year to date. It's still paying out the regular income it pays. Are we worried about that NAV? Because, many people are in it. I personally believe it's one of the best funds that we have. The sad thing about if you consider selling this fund is you lose that income that's paying out. And that's the most important thing. The capital will be maintained. I think the manager has reduced risk. We've seen how they've reduced their equity exposure. Global equities a year ago in February of last year, global equities was their number one position. And now it's high yield bonds, right? So you're seeing active management there, and that's adding comfort to me. I think it's a fantastic strategy. For those that don't have it, it is a little bit off the highs this year, so it's a good opportunity to buy. for those that have it, I suggest that it's something that you should continue to hold on to.
Yeah.
And keep receiving that income on a monthly basis that you're getting, and the manager is doing the adjustments necessary to really keep that capital whole. No? So that's just something I just wanted to add before we close out today.
I mean, it's messy, bloody, but that's where
So it's not
active
buy blood on the
managers-
street. Buy when there's blood on the streets. Wala pang blood.
wala pa. But, there's, a lot of real damage that's being created too.
Some companies,
You
I
wanna
guess. There's a
avoid
lot
that.
of blood in some companies.
Yeah, I mean, this is where, maybe in the last 3 years, if you invested in the US, it's a tide that lifted all boats, liquidity. But now I think it's really the time to shine for active managers.
Right.
This is where we can demonstrate the value that we're adding to clients' portfolios. And there's no excuse. Professionals need to be able to show their worth. Otherwise just do an index fund. But yeah.
Well, great, Sandra. Well, thank you. Let me try and sum it all up then. We asked 3 questions, right? What's going on out there? How's it going to impact the Philippines? And what to do about it? So I guess to sum up, to do the elevator pitch in 2 minutes about what's going on out there is it's very noisy out there. There's a lot of market reaction to a new tax regime in the world that we're not clear of what it is yet, but we will know more in 90 days. I think we've seen the worst, well, maybe the potential high case scenario for the tariffs, and we expect negotiations to fall somewhere in between. I think that was the original expectation of markets before the announcement last week, but the announcement last week was the worst case scenario, then worse than the worst case scenario. And so everybody had to retool. Markets reacted to that. There's dust that's settling. The reaction has not been, it's been scary, but in hindsight, a 10% correction in the Dow Jones and 15% correction in the S&P, to me, there are many reasons that could have been justified. So let's see what happens. In the meantime, slow growth in the world means low energy prices, which means for the Philippines, it's not going to be so bad. We're going to have growth. We're going to have 5% growth. We're going to have growth in earnings. We're going to have potential opportunity, which is not yet clear, but more upside than downside, I guess. It's the risk reward for the Philippines is more upside than downside. And finally, what to do about it. From the global side, we have bond market, the bond funds, both the money market, dollar money market, and dollar bond, plus the 2 equity funds that if you're adventurous, the dividend fund and the infrastructure fund would be 2 that might work well in this scenario. If you're invested in tech and if you're invested in global multi-asset, stay invested in them. Those are 2 fantastic funds that will continue to do well over the long run and achieve their objectives. And then finally, for the Philippines, again, take advantage of yield. The bond market is there working for you. So money market, on track to deliver around 4% this year if things go the way they went in the first quarter. And the medium-term total return bond fund, a little bit higher than that, and maybe tracking closer to 5%. And if rates go down, maybe even more. So 2 good opportunities to make money. In stocks in the Philippines, of course, we have the index, which has upside, but a different way to play that would be the Alpha Opportunity Fund on the small mid-cap space, and then Sustainable Development Fund for those that we think continue to do the right thing as they move along.
Yeah, and Phil, I'd like to encourage the audience to feel free to consult with ATRAM, no? This is the time also where we want to, hold our clients' hands and give them more a sense of calm. So just reach out to any of your relationship managers, and we'll certainly be giving you more or keeping you posted about all of these developments as they happen.
Well, I hope you enjoyed this episode, guys, and gained some insight from obviously our expert, Sandra. Please share this with your colleagues and friends. You can find the ATRAM Game Changers podcast on Spotify, Apple Podcasts, and YouTube. And don't forget to hit that subscribe button so you don't miss out on our chats. Anyway, have a great day. Have a great week ahead. Sandra, thank you very much. And chill, man. We'll be okay. Peace.